Global funds have become an attractive option for investors looking to diversify beyond their home markets. These funds invest in companies across multiple countries, providing exposure to developed and emerging markets. Whether you're looking for growth, stability, or a hedge against domestic risks, global funds offer a strategic way to access international opportunities. What are global funds? Global funds are mutual funds or exchange-traded funds, ETFs, that invest in assets across different countries. Unlike international funds, which exclude the investor's home country, global funds include both domestic and foreign investments. These funds provide exposure to global economic growth, currency fluctuations, and different market cycles, making them a valuable addition to a diversified portfolio. Types of global funds. 1. Global equity funds. These funds invest in stocks of companies worldwide, including large-cap, mid-cap, and small-cap firms. They often focus on blue-chip companies like Apple, Amazon, and Nestlé. Growth stocks in emerging markets like China, India, and Brazil. Sector-based investments, such as technology, healthcare, and energy. 2. Global bond funds. These funds invest in government and corporate bonds from various countries. Stable income with lower risk than equities. Exposure to different interest rate environments, balancing risk and return. Currency diversification, which can protect against inflation. 3. Global balanced funds. A mix of stocks and bonds, global balanced funds aim to provide growth and stability. They are ideal for investors seeking moderate risk with long-term growth potential. Advantages of global funds. 1. Diversification. Investing in multiple countries reduces country-specific risks like economic downturns or political instability. If one region underperforms, another may offset losses. 2. Exposure to high-growth markets. Many global funds allocate capital to fast-growing economies in Asia, Latin America, and Africa, offering higher return potential compared to developed markets. 3. Currency diversification. Holding assets in different currencies can help protect against domestic currency devaluation and inflation. 4. Access to international leaders. Global funds allow investors to own shares in world-renowned companies, even if they are not listed in the investor's home country. Disadvantages of global funds. 1. Currency risk. Fluctuations in exchange rates can impact returns, especially when converting foreign earnings into the investor's local currency. 2. Political and economic risks. Investing in foreign markets exposes investors to geopolitical instability, trade regulations, and economic downturns in different regions. 3. Higher fees. Due to international transactions and management complexity, global funds often have higher expense ratios than domestic funds. Are global funds right for you? Global funds can be an excellent choice for investors looking to diversify beyond their home country and gain exposure to global economic trends. They are best suited for long-term investors seeking international growth opportunities. Moderate to high-risk investors comfortable with currency and political risks. Those looking to hedge against domestic market downturns by holding assets across multiple regions. Global funds offer a powerful way to expand investment opportunities beyond borders. By investing in international markets, these funds provide growth, diversification, and risk management benefits. However, investors should carefully evaluate fund expenses, currency risks, and global market conditions before making investment decisions.